Hello and welcome everyone again to Richardson Capital Management's Economic and Investment Update. This is going to be for the first quarter of the year 2022. And Dan, this started out as a very volatile market for us. What are some of the catalysts that are driving this?
Yeah, so we started the year with record high prices in the stock market, but then the first week of January, we started to experience a correction. So some of the catalysts that pushed stocks lower during the quarter were investor concern over the 40-year high level of inflation and how aggressive the Fed is going to be to combat that inflation and try and bring the price level down through raising interest rates. And then in February, we saw that military conflict between Russia and Ukraine, which created additional uncertainty and pushed prices even higher, especially for some key commodity exports like energy, fertilizer, grains, etc. So all of that led to about a 13% decline in the first quarter for the S&P 500. So we saw that bottom around the first week of March, and then stocks actually staged a fairly impressive rally the last 3 weeks of the quarter. So finished on an encouraging note as investor concerns seemed to dissipate a little bit. We saw some negotiations going on between Russia and Ukraine, and investors are feeling a little confident that inflation is going to come down later in the year.
Yeah, and Dan, the other thing we saw is the Federal Reserve raised interest rates for the first time since 2018. I mean, what kind of impact did that have on the fixed income market?
Yeah, good point, Mark. So switching gears from stocks to bonds, I think investors correctly anticipated that the Fed would begin raising interest rates. So we saw interest rates rise fairly steadily throughout the first quarter. And what this did is it produced negative returns for the fixed income market, in all 3 months, January, February, March. And the Fed, as anticipated, began to raise interest rates from near zero at the March meeting, and they raised interest rates by 1/4 point, or 0.25%. And then later in the month of March, we heard from Fed Chairman Jerome Powell during a panel discussion, and he was talking pretty aggressively about the Fed continuing to raise interest rates throughout the course of this year. And there's a lot of investor sentiment thinking that the Fed could actually raise interest rates at the next couple meetings in 1/2 point increments. And again, all this is due to the fact that inflation's at a 40-year high, and they are talking fairly tough about trying to bring that level of inflation down. And we think the Fed's got a little bit of runway here to be somewhat aggressive with raising interest rates because the overall economy is in a pretty decent situation with corporate earnings. The employment situation is very solid with the unemployment rate around 4%. Weekly jobless claims are trending at decade lows, and we count about 10 million to 11 million job openings in the economy. So again, we think the Fed's going to be fairly aggressive here in raising interest rates, over the course of the next year. And unfortunately, this is going to be tough for the fixed income market, the traditional fixed income bond market, and we think those investments could generate negative returns this year for the first time in many years. So a pretty challenged outlook for fixed income for the next year or so.
And Dan, is one of the other things we keep an eye on is just the overall price of gasoline. I mean, what is that doing to consumer spending?
Yeah, so far consumer spending is holding in there just fine. So we saw gas prices peak at a record high over $4 a gallon in March as oil peaked at over $120 a barrel. And we went back and looked at research that basically shows that even though inflation's at a 40-year high, and a big cause of that is the rising energy prices, that our economy over time, the last 4 or 5 decades, has become more energy efficient. And what we're looking at here is the price of oil, plotting on the right-hand side of the graph here, again, peaking at over $120 a barrel in the month of March. And the good news of this graph is the fact that we're looking at energy consumption as a percentage of disposable income, basically declining fairly steadily. So it peaked in around 1980 at about 8%, but for the past number of years, this has bottomed near around 4%. So we're thinking this is an encouraging sign for consumer spending to hold in there, as consumer spending is a big part of the overall economy.
Okay, so basically we've made it through the first quarter. It's been a pretty bumpy ride. What's the rest of the year going to look like for us, Dan?
Yeah, we think that volatility could continue for the remainder of the year as investors get comfortable with the Fed raising interest rates. So it's very possible the Fed raises interest rates at every subsequent meeting here throughout the year. But again, they're raising interest rates from zero, and they're going to do it in a fairly measured pace to try and bring inflation down. So we think inflation will begin to moderate later in the year, which will be a positive sign. So we still think the outlook for stocks that they can generate, mid-single digit type of returns, We've been saying and writing that for a while now. Fixed income, we think, could still be challenged in a rising interest rate environment. And we've taken steps in the portfolios to modify the fixed income weightings and positioning. And we like some of the liquid alternatives as a fixed income substitute. So we think overall, we're still in a good place with corporate earnings and employment situation very strong. So trying to remain optimistic on the outlook here.
So that's a good wrap up for our first quarter for 2022. Please hit share and subscribe on the videos if you're finding value in them. And we look forward to talking to you next month.